Hello, everyone. This is Rob McDougall from Zhang Financial here today with your weekly economic update. Today is Monday, April 29th, 2024. So last week, huge week in terms of economic releases, just scores of different releases that came out. The biggest one that came out, no doubt, was on Thursday, I think, which was the U.S. GDP number. So I'll just hit that one right away and admit I was way off on this. The Atlanta Federal Reserve had estimated U.S. GDP growth in the first quarter at 2.9% just a week before last. My best guess is it probably would have exceeded that because it has been exceeding expectations, including that of the Atlanta Feds. Didn't happen this time. So on Thursday, GDP growth for the first quarter was released. It wasn't the 2.6%, which was consensus, or the 2.9 from the Atlanta Fed. It came in at 1.6, so far weaker than expected. And we'll go through what the results ended up being in terms of how the market responded, but we actually had a good week in equities here in the U.S., despite the fact that U.S. GDP growth far lower than we expected and most investors. So let's hit a few other things first, and we'll circle back to that. So last week we also had new home sales, building permits, durable goods orders. I won't go through the exact numbers on all these, but they were actually good, actually a little bit better than expected. So coming into Thursday in the GDP report, it seemed to corroborate our expectation that GDP growth was probably higher than estimated. And again, on Thursday, we found out it wasn't. Then on Friday, we also got inflation number. The thing you definitely don't want as an investor is the period that we had back in the late 1970s called stagflation. Stagflation is where you have inflation and very low economic growth, or negative growth, but low economic growth and inflation. So definitely don't want to see that again. And the data point that we got on Thursday suggested it's a possibility, clearly. Slowing growth, 1.6%. And then on Friday, we found that the PCE and PCE core were actually a little bit elevated. They both came in at 0.3% month over month, but that's a trailing inflation rate of 3.4 and 3.5% respectively, which is well above the Fed's target of 2.0 and actually has moved the wrong way for the last 3 months. So some of the pressure that's come, we've talked about it before, the fact that oil prices / energy prices year to date up low double digits. Also the fact that real estate, residential real estate, the prices have been very sticky, much more so than many would have expected, with a 30-year mortgage rate at 7%, up from less than 3% a year and a half ago. So it just turns out a lot of real estate investors are choosing not to sell and get rid of their low mortgage rate. So bottom line is that we are seeing a situation where inflation kind of moving in the wrong direction and GDP slowing. So hit the panic button? No. And investors didn't. I think that's in part because GDP growth has been really strong over the last 6 quarters. Again, generally exceeding expectations. It is just 1 quarter, and we have to consider the fact that the Federal Reserve started raising rates almost 2 years ago. I think it's 22 months now. And there's always a lagged effect. We know that. Economists estimate that at 12 to 18 months. We're a little past that, but that may be part of what we saw in the first quarter and the reason why we didn't quite hit what we expected in terms of GDP growth. Time will tell. We'll see. But it's interesting to note. So of the numbers last week, again, GDP growth worse than expected. PCE sort of in line, but again, elevated. Certainly, those aren't great metrics, but the market did react in total fairly positive to it. So a couple things about last week in terms of now what we expect for the Federal Reserve. They're actually meeting this week, so they'll have an announcement on Wednesday, and the expectation is there'll be no increase to the Fed funds rate. In fact, the expectation is 97%. There will be no cut. I'm pretty confident there won't be. And now the expectation is, in terms of cuts by the end of the year, almost a 50% probability that we might get 2 cuts. If we do get them, it's going to be back-end loaded later than most investors had expected. Again, coming into this year, As we said many times, investors were betting we would get as many as 6 rate cuts during 2024. That's been scaled back to 2 expected at this point. So here's what kept the market in place last week, with the wheels coming off despite GDP growth less than expected, inflation disappointing, and that's corporate earnings. So that is definitely one of the legs of the stool in terms of keeping the equity markets up. So we definitely needed to see good earnings, and during the week we certainly did. So through the end of Friday, out of the S&P 500, we've had 46% of the companies that have reported earnings, and 77% of that 46 beat expectations in terms of earnings growth. So that's solid. Expectations now for the second quarter, still about 3.5% is the expectation for the earnings growth that we had for actually the first quarter. And the expectation now is that for the full year of 2024, S&P earnings growth will be 10.8%. And we're expecting further acceleration into 2025 with the expectation of S&P earnings growth in 2025 going up another 13.9%. So, as I mentioned, somewhat disappointing economic news last week, but the S&P earnings were good and the market responded positively to it. So the S&P 500 last week was up roughly 2.7%. And as a reversal from the week before, large cap growth came back with a vengeance again, as did tech stocks. So while the S&P was up 2.7% last week, the NASDAQ was up 4.2%. So on a year-to-date basis now, S&P 500 is up 7.4%. The NASDAQ actually trailing that now, which didn't happen last year. But the NASDAQ now, if year-to-date, is up 6.1%. Again, S&P up 7.4%. International markets last week, they were up as well. The developed markets not as strongly as the U.S., but developed markets last week were up 1.7%, S&P up 2.7%. Emerging markets actually beat U.S. returns. Hasn't happened often in the last 10 years. Has from time to time, but certainly not on an annual basis. But last week, emerging markets were up greater than the S&P 500, up 3.7%. And what really drove that, in part, China. China has been beat up this year in terms of equities. Trailing 12 months, not great. It's had a tough time the last several years, but China was up 8.2% last week. And now, for the full year, year-to-date, is up 4.3%. So in fixed income in the U.S. market, I would have expected some real movement here last week, given the inflation numbers that were a little disappointing, economic growth a little less, but hardly any move at all. 2-year Treasury, no move at all. 10-year Treasury is up 4 basis points. So the Bloomberg U.S. Aggregate Bond Index, most widely quoted, one that we follow, we often cite, was pretty much flat. It was down 8 basis points for the week. So let's switch gears, take a look at economic data that is coming out this week. Not nearly as impactful as what we saw last week. In fact, really nothing going on. I think until Friday, we have the ISM coming out on Wednesday. It is now just barely hitting the non-recessionary environment level. 50, the number 50 for the PMI index is a demarcation line between a increase or decrease in terms of economic activity for the PMI, and it just hit 50 last month for the first time, I think, in over 12 months. Came in at 50.3 and is expected to barely be over 50 again for the month of April. It's expected to come in at 50.1. Also on Wednesday is the Fed meeting, or the announcement, I should say, in terms of interest rate change. Very unlikely there's any change. The commentary, however, will be very interesting given what we saw from the GDP number last week and from the PCE numbers. On Friday, we have non-farm payrolls. This will be interesting. Certainly to me, what seems to have happened a lot over the last year and a half, is we will print a given non-farm payroll number for a month. The next month will come out, and almost invariably the prior month and the prior 2 months get revised downward. So we're going to be watching for that. But the expectation now for the April number coming out on Friday, that we created 243 jobs, 243,000 jobs. That's a consensus number. The prior month, the month of March, we added 303,000. That's the number to watch to see if that gets revised downward. Pretty likely it's going to. Unemployment rate expected to be the same, tracking at 3.8%. That's what it was in March. Average hourly earnings, that is not expected to change either. March, it was up 0.3% month over month, expected to be the same, plus 0.3% in April. So that's it for the economic update for this week. We thank you very much for you tuning in to see us, and we hope to see you next week. Thank you.